Welcome to Quiver Financial's market update for March 2024. Find out what we're seeing in stocks, interest rates, metals, and oil. I'm Colby McFadden with Quiver Financial, joined with Patrick Moorhead and Justin Singletary. Gentlemen, welcome to March of 2024. So I want to start the conversation with interest rates because it was like October. Everybody was like, oh boy, higher for longer. And then all of a sudden, the whole narrative changed around interest rates. And I don't know what happened. Everybody went from, oh my gosh, the Federal Reserve isn't raising interest rates, and now they're going to lower them. Like the narrative of the market went from, hey, we're going up to we're going down. And it's like, did people forget that they can also just kind of sit and do nothing for a while? So I'm going to talk about that and pull up some charts and talk about what to watch for, because we can't predict what's going to happen next, but there's some things that we should watch for, because if they develop, then we can get ahead of the curve with some ideas. So this is the chart that we put out in January when we threw out our 2024 outlooks. And so I circled at the top right. December 10th is when we created the chart, and right around that time frame, the commentary that we had was, I wouldn't be too surprised if the first couple months of the year we see rates tick up a little, tick back down into the summertime, and then possibly go higher from there. Now, why am I looking for that? Why would that be something that we're curious about? So here's an updated chart, and we did see that in the first 2 months of this year, we saw a little uptick in interest rates. This is the 10-year Treasury that we're looking at. And so now I'm thinking what I want to watch for is if we see a little decline in rates and the 10-year starts to get a little bit softer here going into the summer, it's going to hold the economy together. It's going to hold the market together probably. And if that's happening, if we're starting to see rates kind of trend lower into the summer, however, we start to see oil prices increase and shelter prices, they don't even have to increase. They can just stay where they're at. But if we just get some uptick in energy prices, that could be enough to prevent the Fed from having the ability to lower interest rates. Because the inflation numbers won't get below where they are now, which is right around 3%, and their target's for 2%. So interest rates, historically, they always trade in a range based on the perception of where the economy is. And you can see this in the chart. This goes all the way back to like 2012. And you can see from this time frame that for 6-7 years, the 10-year traded between basically 1.5 and 3. If you can get the 10-year Treasury to stay in a range like that for multiple years, that's like a Goldilocks scenario, and that's great for the stock market. And I think what the 10 years trying to do here is it's trying to figure out, where is this new economy post-pandemic? What is the real activity that's going on in the economy? And if things stay pretty steady, if we can stay 2 to 3% inflation rate, then maybe rates stay right in this green pattern for a period of time, and we create a new Goldilocks of between, let's say, 3.5% to 5%, and we just bounce between there and there. That would be the golden scenario, and that's what really the market has priced in right now, is my belief. The market thinks that this is what is transpiring right now. And so if that's the case, we want to really watch for what could surprise the market. And what could surprise it is that rates go higher for longer. And the fundamentals that I would have to see that happen is, like I said, I'd have to start to see that energy prices got weaponized in an election year. And that's fairly possible. We don't know if it's going to happen or not, but if I start to see that kind of rhetoric and I start to see oil prices continue to push higher later this year, even as interest rates kind of settle, then there's no way the Fed's going to lower rates in June, and they're going to have a heck of a time doing it in September, because as you get closer to November, they're not going to raise rates right in front or right behind the election. They don't want to be blamed for interfering one way or the other. So I think for all of us as investors, The good news in this is that the rhetoric around higher rates has calmed down, and we can go back to some interest rate sensitive items and start to get some dividends and income from it for a few months while this starts to play out. But we've got to be really aware of this red pattern, that if it starts to develop, that we get another 5-wave move higher, because we had one here already. So the normal technical pattern would be a 3-wave correction, and then all of a sudden we go through growth again. If we start to see that, then we'll start to come back out to people and say, hey, now you got to protect your portfolio, because when you get a run-up in interest rates like this in 2022, it does a lot of damage to lower risk, high-yielding type of portfolios. So those are the things I'm watching for. I hope we stay in Goldilocks. I hope we stay in this range. But if I start to see signs that we break out of that, I think it's something important to watch for.